Hello and welcome. In this session, we are going to combine what we have studied till now. We have studied what is portfolio risk, we have discussed what is portfolio return. Now, let us bring them together. So, this is an example of a portfolio line, capital asset pricing line. So, on the x axis, we have standard deviation, on the y axis, we have expected return. So, we are comparing returns versus risk. So, we are combining both of a portfolio returns as well as risk. Now, this line represents what are different risk and returns of a portfolio based on different combinations of their constituents. So let's say we have two assets in our portfolio, equity and treasury. So what we are doing, this is 100% treasury. This blue point is 100% treasury. So we are adding equity. We keep on adding equity until we go to this point, that is 100% equity. So this line represents various combinations of equity and treasury, right, and their respective risk and returns. So once again, this is 100% treasury, this is 100% equity, and we are moving on this line by adding equity to our portfolio. So if this is 100% treasury, then this will be 90% treasury, 10% equity, 70% treasury, 30% equity, 50% treasury, 50% equity, and then 100% equity. Now what do we see? That 100% treasury, 100% risk-free asset is not the is not the least risky portfolio. So we can reduce the risk of a portfolio by adding certain part of equity because they have negative correlations. So if two assets you combine and they have negative correlations, you can even reduce the risk of a portfolio below the least risky asset in the portfolio. So treasury had, let's say, 1% risk, so we can go below this risk by adding equity because they have negative correlation. So this point is called as the minimum risk portfolio. Okay, this point, this red box that you see is the minimum risk portfolio. Any portfolio that is below this minimum risk portfolio is the rejection zone. Any portfolio that is above this minimum risk portfolio is the acceptance zones. Okay, so portfolios that are lying on this line till this minimum risk portfolio, we are going to reject. Portfolios that are lying on this line above the minimum risk portfolio, we are going to select. This portfolio has the highest amount of return and the lowest amount of risk. So it represents a point on this capital asset pricing line which is giving you highest return for the least amount of risk possible. So as we move along this line, the risk keeps on increasing as well as returns keeps on increasing till this point. Now beyond this point, you can only go if you start taking leverage on the portfolio. That is, you borrow money at a lower return and you invest money in the market return. So this 100% equity portfolio is also called as market portfolio. So just to recap, we are combining risk and return. This blue line represents 100% treasury. This green line represents 100% equity. We are traveling on this line by keeping on adding equity, to our portfolio. This portfolio, this orange box represents minimum risk portfolio that is possible. Okay, and this is not the treasury portfolio, so it has some part of equity. All this zone that is below minimum risk portfolio is the rejection zone. We do not select any portfolio on this line because for any of these portfolio we have a better alternative. For same amount of risk we can get better returns if you go above the line. So this is called as the rejection zone. This is the selection zone, and we can increase return beyond the market, right, by borrowing at a lower rate and investing in market portfolio. So this green box is called as market portfolio. You can beat even the markets if you take leverage on your assets. So you borrow at a lower risk or borrow at a lower return, and you invest at a higher return. So you increase your risk, even you increase your returns even beyond this green box.